Hey everybody, Jason here again. Hey, I wanted to talk about days till expiration, why I choose certain days till expiration and not others, um, and why that has changed for me over this past few months too, as to where I'm opening up my put credit spreads. So we'll look at 4 examples, a couple being far out of the money, close to the money, a sooner expiration, and a farther out expiration. And also, just to preface this, if you do not understand intrinsic or extrinsic value, that is an important place to start. I made a video specifically about this. I don't expect anybody to go watch back everything. I have a ridiculous amount of videos, but if you search for that, I go into that as far as the differences and why we're seeing extrinsic value. And that is a very important concept, key to options trading, that you really should understand. So there's also not going to be necessarily a right way of doing this. There's statistically going to be an optimal way, which I believe is 30 to 45 days out, where you have the most chance statistically, that's based on market history, back testing, and all the stocks as a collective, to be able to gain the most amount of profit. But we'll take a look at the differences, and all this is going to be a decision for yourself, like what your thesis is, what you believe is going to happen, and whether or not you want to maximize profit. But as you maximize profit, you're going to maximize risk. They go hand in hand. There's no cheat code. You don't get maximum profit with zero risk. It just isn't a thing. Otherwise, everybody would make the exact same play, and we'd all get rich in a couple weeks. So let's take an example here. We'll do 4 different ones, and we'll look at exactly what we gain. So Tesla put credit spreads. We'll take a look at a 690, 680, the credit that we received, and we'll talk about this. So in this case, we're looking at something that's very close to the money. We gain, our upside of this is we gain a lot of premium for our money spent, and we can collect this in a short amount of time. So this would be putting $1,000 collateral up, but we gain $360, $370. And if Tesla stays the same, then we gain that, in a matter of 4 or 5 days, which that sounds fantastic. The downside of this, if Tesla moves against us and it goes down, we're going to lose all of our intrinsic and extrinsic value. This will have so little value that you cannot manage it. So when you see me roll out put credit spreads, and I do it for a credit, if Tesla goes down, that's not an option. You're going to be paying to roll this out. That is the downside of this. Not very much time of managing it. We'll look at one that's pretty far out of the money. So let's look at a 600, 590, almost $100 out. So what's the good and bad on this guy? The good thing is it's very safe, right? Now unless Tesla moves down $100, this is likely just going to print. But the downside is it's only going to print $10 or maybe $9 by the time you actually get it filled. So very safe. So risk is low, but the reward is going to be very low. Also, if it happens to move against us, if some terrible news comes out and it happens to drop below 600, 590, if it hits 550 somehow, I don't foresee that, but you still could lose this, and there would be no time to manage it. So now let's go and look a few weeks out. Let's go and look at like the end of May. So we'll look at the same, I believe we were looking at a 680. Was it a 690, 680? Probably. So we'll look at the 690, 680. So here we have more extrinsic value, meaning there's more time. So we gain more credit. However, upsides and downsides. Upsides, we collect more money. Downside is, in order for us to collect all this, we have to wait more time. So we're waiting 6 weeks instead of 6 days, or 5 or 4 days. So it's a lot longer. We also have time if the stock goes down, then we have two things we can do. We can roll it out if we want, if we're feeling uncomfortable, or we can just wait for the stock price to go back up. So we have all that time on our side. But the downside is, even if Tesla went up or traded sideways for the week, we're not collecting all this. So even if it goes up a bit, we're able to close it for a profit, some profit. But in the first example, where we were able to gain hundreds of dollars in the matter of days, this is going to be hundreds of dollars in the matter of weeks. So this is a slower play, but safer. And let's take a look at one that is really safe. So this is likely what would be the optimal play, and we'll look at that 600. I think 600, 590. So here's our credit here, $2.45, $245. So this is going to sit in what I would recommend for most people if this was financial advice, but this is not financial advice. Don't copy this, don't do this, etc. So this has time on our side, and it's far out of the money. So if Tesla drops $50, $100, we still have time to manage this. We still are likely going to be profitable on this. We get $245, still a 25% premium. We are waiting a lot longer. We're waiting 6 weeks for that, or maybe a shorter amount of time for most of it. Maybe we'll grab $200 worth of this profit in 4 weeks, depending on what happens with price action. But this is going to be a very comfortable situation for a lot of people. And if it starts moving against us, let's say it did drop down to that 550, you can roll this out because it still has time. So let's say over the next week or something, let's say earnings comes out, earnings are terrible, and all kinds of bad news happens. You're going to be able to roll this out, you might need to roll it out 3 months, 6 months, wherever you're comfortable. And you're going to likely be able to still gain a credit as long as it's not too far down. But at least you'll still have your collateral. So let's talk about why this has changed for me over the past few months. So when Tesla was kind of doing its slow rise, I was fine doing them a little bit shorter, 3 weeks, kind of a mix between those, right? About 3 weeks or so, 4 weeks out. Tesla just seemed to be showing strength overall. When it started hitting those super highs, those 800s, I started becoming very uncomfortable with that price, which made me do them farther out because I wanted that extrinsic value to be able to roll them. And I wanted that time. And I was also very uncomfortable with those high prices and thought it could move against me, which obviously it moved against us in a very big way. But what that really allowed me to do is I did roll those out. There was enough value in those spreads to where I rolled some of those out until January 2023. And those are now, I think they're now winners. So if we can, let's look at one. So there are 36 of these that I rolled out a long ways. There they are. Oh, only $35,000 worth of collateral here. And as we can see, let's see, we're not going to see too much, but these were definitely way losing trades. When I moved them out here, I was able to collect some premium and start playing again with that premium. But the downside of this now is because they're so far out, I have to wait to collect all the premium. And I'm not, so if Tesla goes up to 800, I'm not going to be able to just close these out. I still have $600 each to gain by the end of the year, as long as Tesla is above 700 come January 2022. If you had a shorter term contract, a week, you would not be able to do this. You would be able to do it, and you'd probably have to pay for it. But this is what really saved a whole ton of my collateral, was being able to do that. Going back to why this has changed for me. So when Tesla was super far up, I wanted that time to be able to manage these. And as the price has come down, I feel like we're at the bottom. I think we're on our way back up, which is why I've been more aggressive. And by aggressive, I mean shorter time and closer to the money, because I want to be able to collect that premium very quickly. I've seen the catalyst coming. Stock market is pretty much, it's made a bit of a turnaround from when we saw like the whole tech sector going down for a bit. So now I am starting to open them up and roll them out just shorter terms, because I want to be able to roll them out, collect a couple $100 on $1,000, wait a week, and then collect another $100, $200. So I want to be able to roll those out relatively quickly, and that's why it's changed. Now, why do I think it's going to change again? Because after earnings, and this is an after earnings as long as everything is taken on a positive note, and if Tesla goes up, and that is my prediction, is that after earnings, just from various things that I've seen, and or after official Cybertruck announcements, after semi announcements, and some of that actually being into play as far as where the stock price is at, when it goes really far up, let's say it hits $850, $900, I'm going to start playing farther out, both time-wise, so I have time to manage it, and money-wise, so when it blows off some of that steam, that I have time to manage it and collect that money. So there you go. That is days till expiration in a nutshell. There is not always going to be 100% correct, but there will be 100% correct for you and your strategy. I play what I feel. And just ending this as a side note, I did make a couple plays on Tesla, even though I said I wasn't going to. I lied a little bit. So I did grab very short term. I grabbed some 795, 800 call debit spreads, just in case we get that rip up. I in total, all these I'm going to show you, I probably played $100 worth. I grabbed some next week 790, 800s, and that's based on a run up prior to earnings. And I grabbed, and what I pay, $74 for that one. And I grabbed the week after, let's see if we can find these. I grabbed an 890, 900 debit spread. I paid a whole $35 for this, so I probably, maybe $150 on all these plays. And I have one this week is just for earnings run up, next week earnings run up, and this one post earnings if it does really well. This one I may cut out of right after next Friday, because of the anticipation of earnings. It should give this some decent value. But all these I'm not counting on, I'm not banking on all of those. That's why I spent a very small amount relative to my account size. This is turning out to be a long conversation. All right, guys, love you guys. If you have any questions on that, hopefully it makes sense. Go back and watch that intrinsic and extrinsic value video. You should be able to find it. And I know a lot of people have a lot of positions on this, but it's because it's whatever fits correctly for them. All right, love you guys. Have a great day and make a lot of money.